We're going to look at the break-even point for business selling more than one product, operating leverage, and margin of safety. So what a sales mix is you got to figure most businesses sell more than one product. So the sales mix is the distribution of sales among the products sold. So if you sell 10 units total, which comprised of 2 units of product A and 8 units of product B, your mix would be 20% and 80%. So let's look at the Burr Company. So the Burr Company, we sold 8,000 units of product A, 2,000 units of product B. So here's our sales mix, 80% A, 20% B. So if we look at our numbers, our selling price, variable cost, unit contribution margin for each, our units sold, and then our sales mix, we just calculated 80% and 20%. So now what we want to do is combine product A and product B into a combined product. We'll call it product E. So what we'll do is we're going to take the selling price of product A, which is $90, times 80%, which is its sales mix, plus the sales price of product B, which is $140, times 20%, add the two together, and we'll get $100, the unit selling price of the combined product E. We do the same thing for variable cost and unit contribution margin. So if we want to calculate our break-even number for product E, it'd be 8,000 units. 200,000 fixed costs divided by $25 unit contribution margin. The question is, how many units of product A and how many units of product B make up the 8,000? Well, here's how we figure that out. We take the 8,000 break-even we calculated times 80%, which is product A's sales mix, to get 6,400 units, and we get 1,600 units of product B. So if we put together our income statement, sales, variable cost, fixed cost, we get our income operations of 0, which is the break-even point. So the next thing we're going to look at is operating leverage. So this is the mix of variable and fixed costs. So operating leverage is contribution margin divided by income from operations. So typically companies who have high fixed costs have a high operating leverage. And companies with low fixed costs, which are labor intensive, have a lower operating leverage. So what you use the operating leverage for is you can look at how changes in sales affect changes in income from operation. So as contribution margin increases, how does the impact on income from operation? So that's what our operating leverage helps us determine. So if we have a high operating leverage, our operating leverage, let's just say, is 5. So we have a 50% increase in operating income for every 10% increase in sales. So that's high operating leverage. Say our operating leverage is 2. So we have a 20% increase in operating income for every 10% increase in sales. So that's what operating leverage tells you. If your operating leverage comes out to 5, then you have a 50% increase in operating income for a 10% increase in sales. Next thing is margin of safety. This is how much sales revenue can drop before you incur an operating loss. So to calculate this, we take sales minus sales at break-even point divided by sales. So let's look at one. So we assume current sales are 250,000 and break-even sales are 200,000. So then the margin of safety is 20%. So you take 250,000 over 200,000 divided by 250,000. So that means sales revenue can drop 20% before you incur an operating loss.